I made this chart. It looks a little funny. Why? Because when you go back all the way to January 18th, 1980, stock charts does not have intraday pricing. All they have is the close. That's the data that they've got. So the open is 49.45, the high was 49.45, the low was 49.45, and the close was 49.45. And so it's just a single line. But what I wanted to show you, this was the previous high back in, so this is the close that people refer to back in 1980. That is the high. So from Peter Spina, silver closes at historic highs in London. Highest price close in history. Exceeds January 1980's prior record close of 49.45, and it closed at 49.68 rounded. Silver set to break intraday record highs from January 18, 1980. Chicago Board of Trade, $52.80. And so I made this chart just a little while ago. This goes back to Monday before last. And when you're looking at these candles, for anybody that doesn't know how to read them, the fat part, when it's a hollow body candle like this, the fat part at the bottom is the open, and then the intraday price action as things are going up and down is the wicks that might stick out of both ends, maybe not like this candle. And then the close is up at the top of the fat portion of the body. A black candle, this was the open, the intraday, and then the close is at the bottom. So Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, boom, and then something happened, something changed, and the price fell dramatically and closed below its open. However, the close was still above the previous day's close. So based on a closing basis, this has still continued an uptrend. But this is, I think it's called a shooting star. It's a bad omen. It's technically it's supposed to not be a good sign. However, since it closed above its previous close, it's still an uptrend, and it doesn't matter. And when everybody looks at this, they scream manipulation. It's got to be manipulation. Well, in this case, it was, and I think I've got some evidence here. I think what happened. So, Bob Coleman, CME margin increase alert. COMEX increases margin requirement for gold 5.8% and silver 9.3%. So, what I believe happened is it opened and it just started, it may have fallen a little and then starts taking off like a rocket. And right about there, they announced the change in margin requirements. What does that do to all the people that are holding futures, which is where the spot price is derived by the paper market? And so all these people that are gambling on the commodities exchange, they've got these highly leveraged positions, and then they get a margin requirement, which is basically a margin call. They either have to cough up that cash or sell part of their position. And so it causes selling pressure. So if they announce it there, people were selling and selling and selling, and then the market closed there. And that avoids forced liquidation. Tomorrow, if they haven't coughed up the cash or sold part of their position, the brokerage house will do it for them and keep whatever they need to keep. But it doesn't matter. This is the 45-year cup and handle that I was the first one to identify. Everybody, including me, we were all focused on this cup and handle that had happened from 2012 until 2024. And then, I said when it breaks this resistance line here, we're going to have a slingshot move, and boy, has it been a slingshot from $25 to $49. It's huge. But what I wanted to show you is I tried my best. You can only move that blue line by 1 pixel at a time with the up and down arrows. And so I tried my best to get this on 49.45. 49.32 is as close as I could get it. The overlap, it doesn't really overlap because this line stopped at the pixel below this line. Anyway, it shows that there's a little gap there, and it looks like it's touching there. However, this is a linear chart where it's a constant percentage change. And so each inch of space on here is the same percentage change as the last inch of space. And it tends to compress all of the numbers at the top and expand the ones on the bottom. If you go to a linear chart, that is a constant amount of change instead of percentage of change. And so that expands the bottom, expands the top, and we have this constant amount change. And now you can really see a gap there. We are way beyond the 2011 high at this point, and the tiny gap that's left is just a few pennies. And we have basically, at this point, completed the 45-year cup and handle that is predicting triple-digit silver, and I think it's going to be mid-triple digits. So, from James Henry Anderson, good friend of mine, he was my the general manager of goldsilver.com when we started out, and he says that Japan Bullion Market Association spokesman is this guy, Bruce Akamizu. Hearing short squeeze in silver. Seems nobody's got silver in London, and lease rates skyrocketed 20 to 30% for short term if you're lucky enough to find a lender. Silver squeeze is on. Silver lease rates now much higher than that of platinum. So there is definitely a squeeze, and it is global. This is Eric Young again. Robert Gottlieb, quote, over-the-counter silver going to ETFs and India demand, basically no free-floating silver left. And Eric says this is the first time ever I read Gottlieb write that there is basically no free-floating silver left.
You know, when I pulled up this chart the other night, I actually laughed out loud. Not because it was funny in the ha-ha sense, but because of how weird it looked, like something out of a time warp. You see, when you go all the way back to January 18th, 1980, stockcharts.com doesn't have intraday pricing data. All they've got is the close. So for that day, the open, high, low, and close are all the exact same number. $49.45, a perfect line, which makes it look like silver didn't move at all that day. But of course, we know better. That day, silver was alive, chaotic, electric, historic. It was the day the Hunt brothers saga reached its crescendo, and it's the day that's haunted silver ever since. Now fast forward 45 years to today. Something incredible just happened. Silver has finally closed higher than that record close from 1980. Peter Spina put it perfectly. Silver closes at historic highs in London. Highest price close in history exceeds January. 1980's prior record, close of $49.45, now $49.68. That's right, we've finally broken the barrier. And the intraday high from the old Chicago Board of Trade, that legendary $52.80, it's in sight. But what's fascinating isn't just the number, it's what this chart represents. Because if you zoom out, and I mean really zoom out, to a 45-year view, you can see something extraordinary. You can see a cup and handle that has taken nearly half a century to form. That's right, a 45-year technical formation that's now finally completing. When I first noticed it, I thought, this can't be real. But it is. That cup, that massive rounding base that started in 1980 and slowly, painfully rebuilt through the 1990s, the 2000s, the 2011 spike, and all the way to today, is finally resolving. And when a technical formation this big breaks out, the move that follows is not small, it's life-changing. I'm not just saying that for drama. I've studied this pattern for decades. I've seen how markets compress energy over time, how the longer the consolidation, the bigger the explosion when it finally breaks. And folks, we've just lit the fuse. Now, before I show you where I think this is going, let's talk about what happened this week, because it wasn't just a breakout, it was also a battle. As silver shot up past $49, traders were euphoric. Social media was on fire. Hashtags like hashtag Silver Squeeze 2.0 and hashtag triple-digit silver were trending. People were posting memes of rockets, moons, and silverback gorillas. The whole internet circus. But then, right in the middle of that excitement, something happened. The candle turned black. For those of you who don't stare at charts all day like I do, that means the price fell during the session. We opened high, went even higher intraday, and then, boom, reversed and closed lower. Not lower than the previous day's close, but lower than the open. Technically, that's called a shooting star. It's usually a bad omen. It often means exhaustion. But here's the thing. This wasn't exhaustion. This was intervention. Right as the price was surging, the CME announced margin increases. 5.8% for gold, 9.3% for silver. If you've traded futures, you know exactly what that means. Margin increases force highly leveraged traders to either add more cash to their positions or sell part of them. And when you're talking about thousands of contracts, that forced selling creates massive downward pressure. In other words, it was a controlled demolition, a pressure release valve to cool things off. And you know what? It didn't even work that well, because despite all that selling pressure, silver still closed the day higher than the previous session. In other words, the uptrend is intact. So yes, technically it's a shooting star, but context matters. Because when a candle like that forms in the middle of a monster breakout, a 45-year breakout, it's not a top. It's a warning flare to the shorts. Now let's talk about what that margin hike really means. It's not just a number, it's a message. It's the CME saying, we see what's happening and we're nervous. Because here's the dirty little secret about the silver market. It's a fractional reserve system. What do I mean by that? It means that for every ounce of physical silver available for delivery, there are dozens, some estimates say hundreds, of paper claims on it. Futures contracts, unallocated accounts, ETFs, swaps, options. All of these are paper promises that rely on a relatively tiny physical pool.
While we see that silver is back over 50, we hit 50 over here to an all-time high of 51 something. This is the London spot contract. This is not New York. And we here hit 51 again. And now we fell back to 48.40 and now we're back over 50. Things are getting really, really volatile because the monetary system is being torn apart at the seams. But what is going on? It's when we're talking about backwardation in terms of New York minus London, and if it's negative, it's not exactly rare. You can see here, if we look at this bottom graph in the gold charts or us graph here of the near month minus the spot. Spot means London, near month means near month in New York. You can see here that very often it's below zero. So technically, as they are counting this as backwardation, and technically you could call it that, but it happens very often. It's almost a mirror image. It's not rare. And it's happening again. You have a -2 spread between the London, which is more expensive, and the New York, which is cheaper. So you're saying, oh, spot is more expensive than futures. Okay, fine, but not a big deal. So what is causing this? And you can see here when we zoom in just for the last 5 years, you can see this happens not all the time, right? And this is pretty extreme. It is extreme. This is not nothing, but it's still not backwardation. You can see the last time this happened was in 2023. It happened in 2024 also, and now it's happening now at the same extent as 2023. That spot silver in London is more expensive than the nearest future in New York. It happens, but it's not rare. So why is this happening? Well, very simple explanation for that. Why is London spot more expensive than New York futures? It's because the supply in New York is extremely high, and it's coming from London and other places. So you see here that the supply of eligible silver, this is eligible silver, it's not for sale, but it is in storage. It's at an all-time high of 339.61 million ounces. And you have the registered silver, which is also right near an all-time high. The all-time high was 200 million ounces. Now it's 186 million ounces. This is all-time high of both eligible and registered silver for sale in New York. So the supplies of silver in New York are very, very high. And the ETFs are mostly not stored in New York. They are stored in London, and that is what's causing the shortage in London. You can see here, the number here is 790 million ounces is the total. This is not the float. And a lot of that is owned by SLV ETF and other ETFs that the silver sits there in London. And you can see last year, the float was higher. It was above 800 million ounces, because this is thousands of ounces. It was above 800 million ounces, and now it's below 800 million ounces. And the ETFs, even though they haven't come anywhere close to where they were in terms of silver storage during silver squeeze, they are higher than they were last year. So you have a severe shortage of silver specifically in London, which is why the spot price is more expensive in London and cheaper in New York. But this is not backwardation. What is backwardation? You see here, this is a contango chart. These are silver prices just strictly in New York. October is here, and it's at 46. This is from yesterday, 2 days ago, so the prices are a little bit off. But you can see here it goes to $52 from July 2030, and this is the cash price in London over here.
Now let's zoom out and talk about the bigger picture. Because what we're witnessing right now with silver isn't just a price move, it's a monetary event. When a market breaks out of a 45-year base, it's not just traders chasing charts, it's history catching up. Think about the psychology of this market. For decades, silver's been the forgotten child of the precious metals world. Gold got the headlines. Gold got the respect. Silver got the memes and the mockery. It was called the poor man's gold. But here's the irony. In every major monetary reset in history, silver reasserts itself faster and harder than gold. In the 1970s, when gold went from $35 to $850, silver didn't just follow. It outperformed, going from $1.50 to $50. That's a 3,000% move. In 2010 to 2011, gold doubled, but silver tripled in less than a year. That's what silver does. It waits, it frustrates, it tests your patience, and then one day it goes vertical and everyone says, "What just happened?" That's what's about to happen again. Now let's go back to that chart for a second. I called it the 45-year cup and handle. The cup represents decades of base building, from the 1980 blow-off top through the suppressed 1990s, the 2008 crash, the 2011 surge, and the long, grinding consolidation that followed. The handle, that's the 2012 to 2024 range. 10 years of quiet accumulation and exhaustion. And now the handle's broken. The slingshot is firing. If you measure that cup, from the base near $5 to the rim around $50, that's a $45 depth. Add that to the breakout point, and you get a target of $95. But that's just a technical projection. It doesn't include the macro environment, the debt, the currency collapse, the supply squeeze. When you factor those in, triple digits isn't just possible, it's inevitable. Let's talk fundamentals. First, industrial demand. The Silver Institute just released its latest report showing record consumption from the solar sector, up over 25% year over year. Photovoltaic demand is projected to exceed 200 million ounces in 2025 alone. Add electronics, EV batteries, medical tech, and you're looking at structural demand that's inelastic. Silver isn't just money, it's infrastructure. It's the bloodstream of the digital and green revolutions. Now combine that with the fact that new mine supply is declining. Most silver mines are byproducts of copper, lead, and zinc mining. So when those industries slow, silver supply contracts, even if demand is exploding. The result? A supply deficit that's widening year after year. The Silver Institute confirmed it again. We're on track for another 200+ million ounce deficit this year. That's unheard of. Now here's where it gets really interesting. While this supply-demand crunch is unfolding, the financial world is leveraged to fantasy. COMEX silver contracts represent hundreds of millions of ounces of paper promises. ETFs like SLV hold inventory that's claimed multiple times through swaps, leases, and derivative layers. So when even a fraction of investors demand physical delivery, the system seizes up. That's what's happening right now. The London Bullion Market Association, LBMA, and the COMEX are seeing lease rates spike, a classic sign of stress. When lease rates for silver hit 20%, 30%, even 40% in the short term, that's not normal market fluctuation. That's a supply panic, and it's global. Japan's Bullion Association reports short-term leasing is almost impossible. Indian refiners are paying premiums just to get physical. European industrial buyers are quietly stockpiling to avoid future shortages. Meanwhile, the mainstream financial media, Bloomberg, CNBC, are either silent or dismissive. You'll hear lines like, "Silver market shows speculative froth." Sure, just like they said subprime is contained in 2007. I've seen this movie before. When the paper market and the physical market diverge this sharply, there's only one possible outcome. The paper burns and the physical revalues. And that's why I say silver isn't just about profits, it's about protection. When this 45-year cup and handle completes, and we are literally pennies away. You'll see the next leg of the monetary reset ignite. Gold will continue higher, but silver will leap. How high? Nobody can say for sure, but based on everything I've seen, the technicals, the supply data, the currency debasement, and the structural leverage in the system, I believe we'll see silver in the $100 to $200 range within a few quarters of the breakout. Some people laugh at that number, I get it. They laughed in 1978 too, when silver was $8 and I said it would hit $50. Then it did. The same laughter now means we're close. Let me wrap this with a bit of perspective. When you hold a silver coin in your hand, you're holding the same thing that bought bread 2,000 years ago, that paid Roman soldiers, that financed the Spanish Empire, that backed the US dollar for most of its history. Empires have come and gone, currencies have collapsed, and every time silver survived. It's not a trade, it's a time machine. It's a bridge between monetary eras. We're now crossing that bridge again. So when you see those weird candles on the chart, when you hear about margin hikes and shooting stars, don't panic. Recognize what's happening. The old system is defending itself. It's throwing sandbags at a tidal wave, but you can't stop a 45-year breakout with a press release. And if you're holding physical silver, real ounces in your possession, you're on the right side of history. So yeah, the chart looks funny, but the story it's telling, that's no joke. It's the story of the end of paper promises and the rebirth of sound money.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.